In 2021, the Bank of Canada dropped the policy rate to an historical low, anchoring millions of households to fixed mortgages of just 1.5%. Those 5-year contracts are now expiring. We have entered the peak window of the Renewal Rift, a cycle where 60% of all Canadian residential mortgages are scheduled for renegotiation between 2025 and 2026. This chart tracks the shock. Borrowers are moving from 2021 rates of 1 to 2% into a stabilization baseline between 5 and 6%. For a typical starter home, this leap translates into a mandatory $700 increase in monthly living costs. The bill for the 2021 macroeconomic experiment has come due. Affordable starter homes are being transformed into significant financial liabilities. A 40% payment shock is traditionally expected to trigger a wave of housing defaults and foreclosures. However, national mortgage arrears are sitting at an historically low 0.15%. Even with massive payment increases, households are keeping their homes. This reveals a significant anomaly. Monthly housing costs have spiked by hundreds of dollars, yet bank repossessions have not followed. The explanation lies in financial Tetris. Households are performing extreme financial maneuvering, prioritizing the mortgage above all other survival costs. The Canadian housing market is currently defined by a crisis of middle-class solvency. Homeowners are maintaining their physical assets by sacrificing their standard of living. The parameters of this exposure are documented by the Bank of Canada, the arbiter of the current interest rate environment. According to the bank's 2025-21 note, the 5-year fixed cohort faces a 20% payment shock at renewal. The impact is highly asymmetric. For the top 10% of variable rate holders, the jump exceeds 40% as they cover the principal gap. Economists track this stress through the mortgage debt service ratio, the proportion of gross income dedicated solely to debt interest and principal. The Bank of Canada projects this median ratio will reach 18% by late 2026. Dedicating nearly a fifth of gross household income to residential debt starves the rest of the domestic economy of capital. The subscription fee for middle-class existence has reached a level that current wages cannot support. To fund these increases, households are forced to look beyond their income. This dashboard tracks the household savings buffer. The pandemic-era high of over 10% collapsed to 4.4%. Households are utilizing expenditure substitution to stay afloat. Spending on vehicles and travel has been cut to fill the expanding hole created by debt servicing. These cuts are required just to manage simultaneous inflation in mandatory survival costs, like groceries and property taxes. Borrowers are also utilizing the amortization trap, extending their mortgage terms at renewal to artificially lower the monthly payment. This provides short-term liquidity, but it trades decades of compounding interest for the ability to meet the current month's obligations. We define this process as a quality Nerf. Homeowners are systematically downgraded in their purchasing power to maintain their status. Canadians are successfully retaining their physical assets, but at the total sacrifice of their long-term wealth accumulation and retirement timeline. A common counterargument suggests that building more houses will eventually lower living costs by creating an inventory surplus. However, data suggests this supply-side rescue is currently mathematically impossible due to failures in construction efficiency. Statistics Canada reports a 37.3% cumulative decline in residential construction labor productivity since 2001. This decline is rooted in the structure of the industry. Over 66% of the workforce is concentrated in small, undercapitalized firms that lack the resources to scale production. As a result, the CMHC projects housing starts in Ontario and BC will drop to near 2-decade lows. In major cities, active listings have reached 10 to 15-year highs. Properties are accumulating because the buyer pool is unable to qualify for financing. We are in a deadlock. Buyers cannot afford the current rates, and builders cannot afford the financing required to start new projects. The stagnation in the building sector guarantees a prolonged inventory overhang, cementing high costs for years to come. While consumers struggle, the banking sector has established a different trajectory. In late 2025, financial corporations reported a 9.0% increase in their financial surplus. This chart captures the divergence. Corporate banking profitability is rising as the household savings rate moves toward 4.4%. Higher debt servicing costs are effectively redirecting disposable income from local communities directly into institutional balance sheets. This dynamic represents a structural wealth redistribution. Billions in household labor income are being repurposed to service the national debt stock. The economy is prioritizing banking system solvency over future domestic consumer capacity. The current low arrears equilibrium relies entirely on the preservation of primary earner incomes. If rising unemployment shifts from youth demographics into the core homeowning middle class, financial Tetris will no longer be a viable survival strategy. CMHC data shows Toronto is already leading the country in delinquency growth, indicating where the first cracks in the system are appearing. The 2026 mortgage wave represents a reset of economic expectations. For the middle class, homeowner status has transitioned from an engine of generational wealth into a significant drain on labor income. Households are deleveraging their lifestyles to maintain the high debt loads of their real estate. Asset retention has become the primary goal, even at the cost of future wealth. If the primary residence is no longer building equity, the entire retirement timeline is broken. To see why your retirement date just moved, watch our investigation into the pension trap.